This is John Wagner with Investment News, and we're here at the Investment Company Institute's General Membership Meeting in Washington, D.C., and today we're talking to Ann Sonders, who's Charles Schwab's Chief Investment Strategist, and she's going to tell us about her views on the market, managing expectations, and what to do with Aunt Martha's income portfolio.
I think it's a fairly easy call to believe that returns are going to be more subdued. If you think about the last 35 years, we had that unbelievable tailwind behind both stocks and bonds with the collapse in inflation and interest rates. And even if we stay at a relatively low interest rate environment, you're just not going to have that tailwind anymore. And to your point in the question, valuations, I think, although not at bull market peak type stretched levels, sufficiently above median levels to suggest that returns are likely to be more subdued. Well, savings rates have already gone up, and that's always the first line of defense, is just saving a little bit more. I think investors who are looking for income but also some modicum of safety ought to consider a diversified portfolio, making sure there is some equity exposure, not only in the U.S. but globally. And the other nice thing is that investors have access to alternative strategies now that in the past they didn't really have access to. So we've seen a democratization in investing that allows investors to take more of a, call it an endowment approach to investing. So the diversification can span beyond just your traditional stocks, bonds, cash model. And I think opportunity for some excess return could be found in some of those alternative areas as well. Well, manage expectations, number one, knowing that if there is a higher risk tolerance, you can go out the spectrum from a risk perspective to pick up yield, but there's risk associated with that. So you need to make sure that where you sit on the risk spectrum is commensurate with what you're looking to generate in terms of income in portfolios. So we think within fixed income, though, diversification is also key. So not just, snugging fully up to treasuries, looking at corporates. Our fixed income group actually has had a more positive view on preferreds, municipal securities. So beyond just treasuries, but again, it has to match your risk tolerance. Right now, it looks like the Fed is going to operate this cycle in a slow fashion, meaning they've already proven that they're not going to, like in 04 to 06, raise rates at every single consecutive FOMC meeting. So this will be a slower cycle, which in the past has rewarded stocks because it ostensibly means the Fed is not chasing an overheating economy or chasing an inflation problem. I suppose there's risk that they get behind the curve. If the acceleration we're seeing in wages, if this minor acceleration we're seeing in inflation turns into an inflation scare, if they maintain a bit of a dovish stance, I think you could have a little bit of concern that the Fed is falling behind the curve. Then, of course, there's also the opposite risk, which is that growth slows more significantly than what we have already seen, and the risk of recession picks back up again. And I think in that environment, correction turns into something more akin to a bear market. So I think those are the primary risks. From an opportunity standpoint, one of the key tenets to my longer term optimism still has a lot to do with the behavioral side and investor sentiment. If you look at the behavioral measures of investor sentiment, things like fund flows, whether it's just mutual funds or inclusive of ETFs, not a single dollar of net new money has come into the U.S. equity market from a fund perspective. I think that tells you that there is some persistence in skepticism and pessimism that is good from a long-term perspective. Some of the attitudinal measures of sentiment are a little bit more mixed, but I think that remains the most powerful support for an ongoing secular bull market. One of the things, and this is also an anecdotal evidence of skepticism and pessimism, whether it's an advisor audience or if I'm speaking directly to the advisor's clients or our own retail clients, I can't remember the last time I got a question that had a positive spin to it. The questions are all almost bordering on Armageddon type questions. What keeps you up at night? What's the next crisis? When is this shoe going to drop? Why aren't you worried about? When is this debt bomb going to implode? When are we going to have to pay the piper? All of those questions. So I think that is top of mind. And maybe it's because we had arguably two financial crises, certainly two massive bear markets in a 10-year period of time, that I think in particular advisors who are advising their clients want to make sure they're not caught on the wrong end of the next one. So we're so hyper attuned to the next black swan or the next financial crisis, that I think sometimes we're missing some of the opportunities because of fear of not getting clients out in the event we have another 2008 type situation. I think we've been in this interesting loop. Bank credit analysts defined it as a Fed policy loop. And I think that really has been a defining factor behind volatility and some of the swings we've seen in the market, and in particular, the very narrow range we've been in for a couple of years. So you go through these periods where financial conditions ease, like we saw last spring, and then it causes the Fed to become more hawkish. They start to hint that they're going to raise interest rates, and then everything sort of shifts, and it starts with currency and it goes into credit spreads and the yield spread and volatility and equities, and then financial conditions tighten and the Fed backs away, and that allows financial conditions to loosen and they step back in, either tighten or they just have more hawkish rhetoric, which causes financial conditions to tighten again, and then they back off. And we have been in this sort of perpetual loop for at least a year now. This is a unique period recently because financial conditions have been fairly easy, but the Fed has not raised interest rates. Now, the most recent minutes suggest they're sending a message, it's coming. Right. So they may be teeing markets up for that. But in general, I think we're probably going to stay in this loop between tight and loose financial conditions and then the reaction of the Fed to those conditions.